Welcome back. We finally made it to our lesson on option pricing. So here's our agenda for this lesson. We're going to talk about option chains, option standards, and option pricing, and then finally how option pricing moves with the price of the stock. Now I want to warn you, this is going to be kind of some nerdy stuff. We've got a lot of details to get through. It's not the exciting stuff about how you make a lot of money with your trades, but it is very, very important. And so let's just get through the lesson, and then in the next lesson we'll kind of look at some of the more of the strategy stuff. But let's start off by talking about the chains and the standards. So we learned in the last lesson that the CBOE, that's the Chicago Board of Option Exchange, they're the central exchange that helps create these standards to make options more liquid and more attractive to multiple buyers and sellers. Well, there's a few specifications that we look at. We've, number one, got contract size, we've got strike prices, and we have the expiration month or the date of expiration there. So let's look at each of these. When we talk about contract sizes, you need to understand that options trade in contracts. When we deal with shares, we deal with stock, we're dealing with individual shares of the company. When we're dealing with contracts, we're dealing with a contract, not a share. And so that contract is going to be written in a certain way. Now in the old days, those contracts would be written between two parties. In the new days, whenever you sign those disclosures at the beginning of opening your options trading account, what happens is you're signing away your right to that broker to trade those contracts on your behalf. And so you literally are entering into a binding contract. When you trade an option, it is literally a binding contract to buy or to sell that stock. You also need to understand that these contracts are for specific sizes. The standard size is a contract of 100 shares. And so when we talk about trading options, more often than not, we're saying we're going to trade one option, which is always going to be 100 shares, or two options will be 200 shares. Each contract represents 100 shares of the underlying stock. And you always need to remember, you're dealing with 100 shares at a time. This can be confusing because the options are actually quoted in per share stock price or option price, but we're trading contracts. So you've got to always kind of multiply by 100 to figure out exactly what the option contract is going to be trading for. You get used to it, you go through it maybe 2 or 3 times, and then it's all old hat, and you're like, that's the way options work. But at first, it can be a little confusing. Next, let's talk about strike prices. Strike prices, they're very standardized for a reason. Odd strike prices just don't make sense. Somebody comes along and says, hey, I want the right to buy General Motors for $41.22. It just doesn't make sense. And so what the exchange does is they say, let's standardize that. Let's come up with some nice increments that work well, and we can have a standard for that. And so that's how the options get issued with your strike prices. So let me show you how the standards work. The standard strike prices for a stock trading between $5 and $25 is going to be an increment of $2.50. So you'll have strike prices that run at $5, $7.50, $10, $12.50, all the way up to $25. Now, when you get to $25, if you've got a stock that's trading between $25 and $200, those strike prices are going to move in $5 increments. So you have $25, $30, $35, $40, all the way up to $200. And so just $5 increments, that's the strike price that you can buy or sell the stock at. And then finally, once you get over $200, we change and we go to $10 increments. So stocks that are trading over $200, the strike prices, the standard strike prices are going to be $10 increments. So they'll go 200, 210, 220, 230, all the way up, and that never stops. Now these are standard strike prices we're talking about, but there's actually some non-standard strike prices that I want to share with you. And this is going to show up on more heavily traded stocks. For example, if you have a stock like Apple Computer, you have a stock like Netflix, a lot of times these very heavily traded stocks will have non-standard strike prices. So let's talk about some specifics here. Most of the NASDAQ 100, you're going to pull up almost any of the NASDAQ 100 stock, and you're going to find that they've got $1 strike price increments. Or if it's really expensive, it may have $5 strike price increments. Some very expensive stocks like Netflix, very expensive and very heavily traded, will have $5 strike price increments. You can still trade them. They're just not the standard 255 and 10. You're also going to find that most exchange traded funds have $1 increments for their strike prices. And then you're going to have some that actually have 50-cent increments. For example, silver, you can have 50-cent increments for your strike prices. Some even more expensive ones like the spiders, you'll find 50-cent strike prices on the weekly options for those. So it's not a matter of what you have to trade, it's a matter of what's available. But you need to understand that the exchanges create standards. Those standards are $255 or $10. Typically, that's the standard. And sometimes you'll be trading a stock and you might think you can get a $1 increment. And sure enough, there's a $2.50 increment. That you may wonder to yourself, well, why are these strike prices not there? Because there's standard strike prices that have been issued. But then sometimes you come along, you find a stock that, hey, this stock has $1 strike prices. Great, you can trade that. It doesn't matter if it's issued, you can trade it. I just want you to understand what the standards are.